Collateralized debt obligation, or CDO for short, is a structured financial instrument that converts a portfolio of loans or bonds or mortgage-backed securities into a pool which is then repackaged into tranches that are sold to investors. In this structure, the junior tranche absorbs the losses arising from repayment defaults, thereby protecting investors in the immediate senior tranche from losses due to default risk. Hence, more senior the tranche, lesser the risk, and consequently lower the returns or the coupon rates. CDOs are structured on several types of assets. A collateralized loan obligation is backed by a portfolio of loans. A collateralized bond obligation is backed by high yield bonds issued by several corporates or sovereign entities. A collateral mortgage obligation is backed by mortgage-backed securities, which is very common in the US financial markets. CDOs can either be balance sheet based or arbitrage driven. Balance sheet CDOs are normally used by banks to offload their risk-weighted assets and thereby obtain relief from regulatory capital. Arbitrage CDOs, on the other hand, comprise high-yield instruments often structured and issued by CDO managers. In both cases, the liability side of the CDO's balance sheet comprise debt paper, usually with guaranteed returns or coupon rates, issued by the CDO manager under a subordinate structure of tranches, as we saw a little while ago. European markets trade predominantly in balance sheet CDOs and very little arbitrage CDOs because of the limited market for high yield paper in the European markets. Almost always a CDO is backed by credit enhancements such as credit default swap, often mandated by the investors in the CDO. In the spreadsheet to follow, we will look at an example of an arbitrage CDO. So here is the subordinated structure in this CDO. The total liability portfolio adds up to 500. It's broken up into one tranche of AAA notes, $350 million, coupon rate 5.45%. A notes subscribe 50 million, guaranteed return of 6.15. Triple B notes 25 at 7.15% coupon, and double B notes 25 at 11% coupon. Now the sum of these adds up to 450, and there is an equity tranche of 50 which has no guaranteed return because all the profits that accrue will go to the equity holders, which in this case would be the CDO manager or his sponsoring company. Now how did we arrive at this weighted average cost of funds? We arrived at this weighted average cost of funds at 350 into 5.45 plus 50 into 6.15 and so on, and you divide it by 450, you get 5.93%, which is the weighted average cost of funds. Now remember, the weighted average cost of funds including equity will be an addition of 50 at no guaranteed return, which is why you get a figure of 5.34. So the cost of funds for this CDO, effectively given these tranches and these guaranteed returns, is 5.34%. Without equity, it is 5.93%. Now what does the CDO manager do? He goes and invests this in a portfolio of high yield debt, the entire $500 million, and let's say for a year, at the end of the year, he realizes an effective return of 10.5%. How does this map into his profit and loss statement? The yield on assets is 52.50. How did we arrive at that? It is 500 into 10.5% would give 52.50, less his funding costs of 26.69. And how did we arrive at that? it is 350 into 5.45, 50 into 6.15, 25 into 7.15 plus 25 into 11% would give you a figure of 26.69. Remember, this is a high risk portfolio, therefore there could be loan losses and the CDO has to meet his expenses. Now generally in the world of CDOs, this is assumed to be 3.25% of the size of the portfolio, which is 500 million. So that works out to 16.25, which is 500 into 3.25, which would give you a figure of 16.25. Now this 9.56 therefore is the earnings of 5250 on the assets less the funding cost of 2669 less the expenses and loan losses of 16.25, which gives an effective profit of 9.56. Now this is great news as far as the CDO manager is concerned, because he invested equity of 50 and on that he got an effective profit of 9.56, which effectively means his return on equity is 9.56 divided by 50, which is equal to 19.13%. Now that's great news, because he took no risk other than an equity of 50 and he got a return on equity of 19.13%. Those of you who understand finance will realize this is an astronomically high return on equity, 19.13%. What you have to realize is this high return on equity was achieved because of his raising money at a much lower cost and taking the risk and investing it in high yield debt, which is giving him a return of 10.50%. Now this whole story looks very nice because everything worked in his favor and he was able to realize a return on equity of 19.13%. Hope that spreadsheet adequately explained the structure of arbitrage CDOs. As would be obvious by now, CDOs are vehicles of very high leverage and it is not regulated in the strict sense of the term. Most of the regulation is through self-regulation by the CDOs themselves, and one of the tests they have come up with is called an over-collateralization test or OC test, which measures the extent of leverage relative to every subordinate structure in the CDO. In the spreadsheet to follow, we will explain the OC test in some detail. This spreadsheet explains to you how the concept of OC test actually works. As you can see, Class A investors have put 50 million into this fund, Class B have put 30 million into this CDO, and Class C have put 15 million, and the equity tranche is 15 million. The total adds up to 110. And the CDO manager would have invested this 110 into assets, high yielding assets, which at this point in time when he purchased it would also be valued at 110. In other words, the mark to market value of the assets is exactly the same as the total of the liabilities. Now remember, what is susceptible to change over time is the mark to market value of these assets. Now let's look at what's in this segment of the OC test. The CDO community have arrived at this minimum OC computations. Now let's look at what this actually means, and in order to understand that, let's look at the over collateralization at the start for this particular CDO. How did we arrive at this 2.20? It is 110 divided by 50, and then if you move to the next one, it is 110 divided by 50 plus 30. So the interpretation for this 2.2 and 1.38 is what is the coverage that the lower tranches provide to the upper tranches. To clarify this even further, if you take Class C, please note the OC is diminishing, it's come down to 1.16 because Class C investors have to give protection for the 50 plus the 30 and the 15 for itself. So that's why you will find that the OC reduces as you get to the more junior tranches. To understand this even better, Let's look at what happens now, which is presented in the second half of this spreadsheet. Now remember, at the time the investments were made, the asset value was 110. Now let's say a time period of a few weeks has elapsed, the market has gone into a tizzy, and the mark-to-market value of the assets invested by this CDO manager turns out to be 100. In other words, the value of the invested assets has fallen from 100 to 110. What this immediately does is the OC now for Class C is 1.05. How did we arrive at that 1.05? It is 100 divided by 50 plus 30 plus 15. Now the mandated minimum for this is 1.10. Now this has fallen to 1.05 because the value of the assets dropped from 110 to 100. In other words, the OC test is breached at this level. So Class C investors are now very exposed. Let us say a few weeks later, the market goes into a further tizzy and the value of the assets invested falls to 90. Now you will notice Class B investors are also in trouble because the minimum OC is 1.20. It was 1.38 when we started. Now because of the reduction in the mark-to-market value, it has fallen to below the minimum OC requirements. It's come down to 1.13. Let's take this a step further. Let's say the market continues to tailspin and the value of the invested assets of 110 has fallen to 75. You will notice even the Class A investors are on the brink because the minimum OC required is 1.50. The OC now is 1.50. So even if the value of the assets fall by a minimum amount below 75, even these guys will be under stress. So let us say the market value turns out to be 70 a few weeks down the road. Even the A class investors are now exposed. This is exactly what happened in the 2008 crisis because the mark-to-market value of all assets went into a tumble, and when that happened, even the safe investors in Class A could feel the pressure, and this is the reason why most CDOs had to fold up. Remember, the reality here is if all these investors want their money back, if the CDO manager were to go and sell those assets, he would only realize 70. The loss, remember, now is 40, 110 minus 70. So he's lost his 15. These guys will get cleaned up by their 15. That makes it 30. And Class B investors would also lose a further 10 out of their 30. Class A is protected. Suppose this falls to 40. There is a loss of 70 that has to be borne now. So these guys get nothing, 15. These guys too get nothing, 30. These guys get nothing, 30. So this adds up to 60. And even the Class A investors have lost $10 million out of the 50 million that they invested. And if you look at this, the OC now is way below the minimum that was prescribed. This is exactly what happened in the 2008 crisis, and all investors in CDOs lost money that they had invested. That was a brief explanation of the structure and computations associated with CDOs. As you might already be aware, excessive issuance of and trading in arbitrage CDOs was one of the major causes of the financial crisis of 2008. It was further aggravated by embedded risks in the CDOs being transferred to other entities, including insurance companies, using credit enhancement instruments such as credit default swaps. The losses inflicted on the financial system through excessive use of arbitrage CDOs backed by credit default swaps was absolutely colossal, amounting to several $100 billion that resulted in some of the iconic investment banks going bankrupt or having to be bailed out by the government, eventually resulting in the global financial crisis of 2008.